All right, so I was talking about depreciation just a moment ago, but residual value. All right, if the lessee obtains the title to the leased asset, they're going to need to know about residual value in order to do depreciation. So when you originally record the cost of the asset, it's going to be reduced by the estimated residual value and depreciated over the economic life of the asset. Okay, so nothing really drastic going on there. If the lessor, though, retains title to the leased asset, okay, so the lessor is going to get it back, right? So this really falls into that, the third and fourth criteria there. What the lessor is going to do is they're going to reduce the fair value of the asset by the present value of the residual value. I know it's a little bit confusing. So the idea is that the reduced fair value becomes the value used to calculate the lease payments. And what it is you would calculate the fair value of the asset, right? And you reduce it by the present value of the residual value. So if you're looking to get this asset back in 10 years, then you would have to figure out the present value today is of that asset 10 years from now. So you'd have to use present value tables of 1 in order to do that calculation. All right, what happens if the lessee actually makes improvements to the leased property, but that they go back to the lessor at the end of the lease? Well, leasehold improvements are allocated as like depreciation expense over the useful life of the asset to the lessee, all right, which is the shorter of the physical life of the asset or the lease term. So what that means basically is the lessee is going to capture it as a leasehold improvement. Usually that's how it's captured on their books. It's an asset, it would be a debit to a leasehold improvement, and they would depreciate it the same as they would any other type of thing. And as it says, over the useful life of the asset, which is the shorter the physical life of the asset or the lease term. Okay, so you would literally have an asset in your books called leasehold improvement that would need to be depreciated. As far as the interest rate that we've been using for all of these calculations, one rate is usually used between both the lessor and the lessee. And what it is the lessor usually says what the rate is going to be that they're figuring out the payments at. So the lessor kind of states the rate. However, and the lessee then uses the rate also. So this way what's on one set of books matches what's on the other set of books. As it says, usually the lessee is aware of the lessor's implicit rate or can infer it from the asset's fair value. But if the lessor's implicit rate is unknown, okay, so they don't tell the lessee, there's no way to know what interest rate they're using, the lessee should use its own, as it says, incremental borrowing rate. And what an incremental borrowing rate is the rate the lessee would expect to pay a bank if instead they borrowed funds to buy the asset. So if they went to the bank and they find out they would have to pay 10% interest on funds, then that's going to be the borrowing rate, the percentage that they use in order to do the calculations on their books. What do you do with direct costs? So the initial costs, the costs in negotiating the lease, the cost in drawing up the lease, right? The legal costs, things like that. So you treat it different ways based on the type of lease you're dealing with. If it's an operating lease, you're going to capitalize and amortize the costs over the lease of the term, right? Over the lease term. So if it was 5 years, the lease term, and you had $1,000 worth of costs, then you're going to put $1,000 on your book and amortize it evenly, straight line, $200 a year. If it's a direct financing lease, right? This is the type of lease where there's simply a finance of an asset, right? Just simply a lease. Then you're going to include it as part of the investment balance, all right? So part of the value of the asset. Sales type lease, this is when you're actually kind of selling it, right? You're dealing with a dealer or a manufacturer, and there's that initial gain, right? That initial sales revenue piece that wasn't in the direct financing lease. The initial direct costs then are expensed at the inception of the lease, so it would simply be an expense. All right, so you treat those initial startup costs in a couple of different ways depending on what type of lease you're dealing with. All right, the last slide that we're looking at here is the special leasing arrangements. All right, there's something called a sale leaseback arrangement, and this is kind of neat. What it is let's say that you own a building, right? You own a building and you own a business, for example, right? So you're running a donut shop and you own the donut shop as well, the actual physical building. And you yourself, you or me, let's say me, Anne Marie Anderson owns it. What I could do is I could turn around and sell the building to an LLC or an S Corp or something that I've created, right? That maybe I'm the owner of. And what would happen is that the property would then go into the LLC, and the LLC would pay me, Anne Marie Anderson, the lease payments. So I would earn money from really the same thing. Technically I still own them both. I own the LLC and I'm myself, so I own the business. But what it is I'm selling an asset and I immediately lease it back from the new owner. So if I did that for myself, then it's kind of an income stream. So it's a neat thing that you can kind of manipulate a little bit to have a steady income. All right. Real estate leases. You've got leases of land only. You could lease a land and building, or you could lease only part of a building. All right. So many leases deal with real estate, right? Because that's a common thing to lease. But the problem is that land has unlimited life. So it requires us to do a little bit slightly different accounting. So if you're leasing land, the ownership can't be presumed transferred like a normal capital lease would be from the lessor to the lessee, unless the title is expected to transfer to the owner. So criteria 1, or there's a bargain purchase option, criteria 2. You wouldn't obviously depreciate the property. So if it's criteria 1 or criteria 2, then you can you can say it's been transferred, but it really doesn't meet criteria 3 or 4, because there's no end on land. There's no criteria 3 with that 75% rule, and there's no expected life like you deal with minimum lease payments for the 90%. So if you're dealing with the land, or the second one, leases of land or building, the lease should record each asset separately. So you have the land, kind of a land lease, and the building lease for that same idea, for that same problem with the land. The present value of the minimum lease payments is allocated between the leased land and the leased building accounts on the basis of their relative market values. All right, so you kind of treat those two separately. Again, these are special arrangements. These aren't the normal ones necessarily that you're going to be seeing, but they do have different accounting treatment. As far as leases of only part of a building, right? And this is pretty common. You're leasing just in one section of a building. Even though it's difficult to determine the fair value of the portion that you're renting, or you're renting a third of the building, a quarter of the building, usable space, square foot space, how do you determine that? Normal lease accounting treatment applies. It's just a little bit more complicated to see if those rules apply. All right, and here's some information on where we're headed in the future. This is one of the areas of contention, leases, how they're handling it, because the FASB and the IASB have differing opinions. They both kind of agree on capital leases, but the IASB is not so fond of operating leases. The IASB actually wants all leases to be recorded as the asset and the liability, except unless it's a short-term lease, and operating leases being altogether eliminated. This is something that is still being worked out, all the details, and hopefully when we finally leave GAAP 100% in the past and we adopt the IASB standards, this will be ironed out a little bit more clearly. But this is one of the areas that they do differ. All right, and that is the end of your lease chapter. Good luck with your homework. Have a great day.